Welcome to the Deep Dive. This is where we take the sources you're interested in and we really distill the key insights. We want to give you that aha moment, but without all the information overload.
Exactly.
Today we're taking a deep dive into the 2024 annual report of U.S. Steel. Now, this isn't just crunching numbers. It's about understanding how a company with, well, over a century of history is trying to forge its future.
Especially now with so much change happening globally.
Absolutely. So our mission for you today is pretty clear. Unpack U.S. Steel's main business segments, understand their big strategic moves, look at the financials driving things, and assess the major challenges and opportunities ahead.
It's a company facing some really dynamic conditions.
It really is. So get ready to gain a clear, comprehensive view of this industrial giant. Okay, let's unpack this.
All right, so what's fascinating right off the bat is how U.S. Steel organizes itself. They've got these 4 distinct reportable segments, plus there's an other category, mostly for real estate stuff. But the main ones are North American flat-rolled, mini mill, U.S. Steel, Europe, they call it USSC, and tubular products.
Yeah.
Each one's got its own, capabilities, its own production numbers, market focus. It gives them some diversity.
And the overall scale is, well, it's pretty significant. They boast an annual raw steel production capability of 25.4 million net tons.
Yeah.
That's across their whole global footprint.
Huge number.
Huge. But let's break down those segments, starting with the biggest one, right? North American flat-rolled.
Yeah. That's really a cornerstone for them. We're talking 13.2 million net tons of annual raw steel capability just in that segment. And it's not just the steel plants, it's integrated. So iron ore, coke production, all here in the U.S. They supply major markets, steel service centers, conversion sector, and crucially, transportation. Think automotive. They shipped, 3.389 million tons just to auto in 2024.
Wow.
Yeah. Plus construction, containers, appliances. It's sort of the traditional heart of their U.S. operations.
Got it. So that's the established core. But then you mentioned the mini mill segment. That sounds like where a lot of the transformation is happening.
Exactly. This is key. Its capability saw this dramatic jump, from 3.3 million tons through Q3 2024 up to 6.3 million by the end of Q4.
Nearly double.
Almost double, yeah. And that's largely thanks to the new Big River 2 facility, BR2. Even with that capacity coming online late in the year, their 2024 production was 2.8 million tons. So running at about 80% of that new higher capability.
And who are they serving from the mini mills?
Primarily North American customers again. Service centers, conversion, transportation, construction. It really shows that strategic shift they're making.
Okay. And then across the pond,
Yeah.
USSE.
Right. U.S. Steel Europe, that holds about 5.0 million tons of annual raw steel capability. Very important for Central and Western European customers, similar sectors. Auto construction, they shipped about 1.2 million tons there in 2024. Containers, appliances.
Auto production.
3.8 million tons in 2024. So running at about 77% capability. It gives them that geographic spread, exposure to European markets.
Makes sense. And the last one, tubular products. Sounds specialized.
It is, yeah. It focuses on rounds, seamless, and ERW steel casing and tubing. OCTG is the acronym you hear a lot.
Oil country tubular goods.
Exactly. Stuff for the oil, gas, and petrochemical markets. So, very tied to energy sector ups and downs. Capability is 900,000 tons, and they produced 575,000 tons in 2024, about 64% capacity utilization there.
So, looking at all these segments, it's not just business as usual. They're actively changing things, aren't they?
Oh, absolutely. It's strategic adjustment and modernization. They finished that non-grain-oriented electrical steel line at Big River Steel in September 23. That's 200,000 tons.
Yeah.
And the really big one, that BR2 mini mill, producing its first coil in October 24, that adds roughly 3 million tons a year of new capability. And it's designed with, state-of-the-art electric arc furnaces, EAFs, plus advanced high-strength steel finishing. Super important for things like lighter cars.
EAFs are key to their future, it seems.
Definitely. And they also completed a 325,000-ton dual coating line at Big River Steel in Q2 24. So moving towards those higher value products.
But it's not just building new stuff, is it?
Yeah.
They're also rationalizing the older assets.
That's right. It's a two-pronged approach. They permanently idled iron making at Great Lakes Works back in 2022. Then the iron and steel making facilities at Granite City Works were indefinitely idle in November 2023.
Indefinitely idled.
Yeah. And even at USSE, they temporarily idled blast furnace #3 in December 24 because of demand, though they do expect to restart that in Q1 25.
So it really paints a picture of this deliberate shift, doesn't it? Away from traditional blast furnaces towards these modern mini mills, the EAF technology.
It's absolutely central to their strategy. Efficiency, lower costs, and importantly, lower carbon footprint.
Right. Let's talk more about that strategy. They call it best for alley. What does that actually mean in practice? How are they executing it?
Good question. The idea is profitable steel solutions for people and planet. Sounds good, right? It centers on leveraging what they see as competitive advantages. Low-cost iron ore, that mini-mill steelmaking we just discussed, and best-in-class finishing.
Okay.
And they break it down into three critical factors. Win in strategic markets, move up the talent curve, and move down the cost curve.
How do we see that playing out?
Well, take safety. They achieved an OSHA days away from work rate of 0.06 in 2024. That's apparently 10 times better than the industry benchmark, which is pretty remarkable.
That is impressive.
Yeah. On the talent side, they talk about leadership training, employee resource groups, inclusive benefits. They had about 22,000 employees at the end of 2024. And interestingly, about 80% in North America and Slovakia are covered by collective bargaining agreements. Unions are a big factor here.
Definitely. And that move down the cost curve piece connects to sustainability too, right? Reducing their carbon footprint.
Absolutely. That's a huge part of it. And also meeting customer demand for greener products. They've set some pretty ambitious goals. A 20% cut in greenhouse gas emissions intensity by 2030 compared to 2018 levels, and net zero emissions by 2050.
Net zero by 2050, that's a big commitment for steel.
It is. And EAF technology is the main driver they point to, along with energy efficiency. They also highlight being the first steel company globally to sell responsible steel, certified steel from their Big River facility. It's a clear signal about where they want to go.
But looming over all of this strategic work, all these investments, is this massive proposed merger, isn't it, with Nippon Steel Corporation, NSC?
Yeah, that's the elephant in the room for sure. Or maybe the elephant trying to get into the room. Look, the stockholders approved it overwhelmingly. 98.8% voted yes.
That's a strong mandate.
It is. And the deal was structured so each share gets $55 in cash. That was a 142% premium over the stock price back in August 2023, before things got really heated. Plus, all the necessary regulatory approvals outside the U.S. came through.
So internationally, it looked like smooth sailing. But then,
yeah. The President of the United States issued an order on January 3rd, 2025, actually prohibiting the merger. This followed a review by CFIUS, the Committee on Foreign Investment in the U.S.
right, the National Security Review Body.
Yeah.
That completely changed the game.
Completely. And the response from U.S. Steel and NSC was, well, pretty forceful. Just days later, January 6th, they jointly filed a lawsuit in the D.C. Circuit Court of Appeals.
Against the president's order.
Directly challenging it. They allege, and we should stress this is their allegation, that the order was for purely political reasons, irrelevant to national security, and violates their due process rights.
Wow. Taking on the executive branch directly.
And that's not all. Simultaneously, they filed another lawsuit, this one in Pennsylvania District Court. This one targets Cleveland-Cliffs, a major competitor, and the USW president.
The Steelworkers Union.
Yes. They allege a coordinated series of anti-competitive and racketeering activities illegally designed to prevent any party other than Cliffs from acquiring the company.
So they're fighting on multiple fronts. Legal, political, competitive. It's incredibly complex.
It really underscores the high-stakes environment they're in. It's way beyond a typical M&A deal now.
Yeah. And besides this whole merger drama, what other risks are they facing? Just the general business risk?
Oh, yeah, plenty of those. The report flags the huge issue of global steel overcapacity. They estimate it at over 630 million net tons per year.
It's enormous.
It puts constant pressure on prices. So they're actively defending things like the Section 232 tariffs and various anti-dumping duties to try and protect the domestic market from what they see as unfairly traded imports.
And competition from other materials.
That too. Aluminum, plastics, especially in automotive where lightweighting is such a big trend, that could definitely eat into steel demand over time. So lots of challenges beyond just the merger.
Okay, let's pivot to the financials then.
Yeah.
How did they actually perform in 2024 amidst all this?
Well, let's look at the numbers. Net sales came in at $15.6 billion for 2024. But net earnings attributable to U.S. Steel, that was $384 million.
Which sounds okay, but how does that compare?
It's a pretty significant drop from 2023 when they earned $895 million, so earnings were less than half what they were the year before.
Ouch, why such a big decrease?
The report points mainly to those lower net earnings themselves, but also changes in working capital. Basically, cash got tied up maybe in inventory or receivables, which impacts cash flow.
And looking at the segments, do they all struggle?
It was pretty consistent across the board, yeah. Flat-rolled saw lower sales because shipments were down by 861,000 tons, and the average price per ton dropped by $17.
Okay.
Mini mill, similar story. Shipments down 117,000 tons, average price down $18 per ton.
And Europe.
USSE faced lower sales, too. Shipments down 321,000 tons, and prices fell more sharply there, down $69 per ton on average.
Seems like pricing pressure was widespread.
It was, but two-dealer was hit hardest on price. Shipments were down, yes, but the average realized price plummeted by $1,232 per ton.
Wow, over $1,200 a ton difference.
Yeah, massive drop. Really shows you the volatility in that oil and gas market they serve.
So top-line challenges, lower earnings. How did they manage their balance sheet through this?
They were actively managing debt. They repaid about $128 million in debt during 2024, and they ended the year with $3.62 billion in total liquidity cash and available credit, which gives them a decent buffer.
Any other financial moves worth noting?
Well, back in May 2023, they issued $240 million in green bonds. That was specifically to help fund the BR2 facility. It signals, their commitment to tying financing to their sustainability projects.
Interesting. What about returning value to shareholders?
Yeah.
Dividends, buybacks.
They kept the quarterly dividend consistent at 5 cents per share, same as 2023. So they maintained that.
Okay.
But, and this is a big but, no share repurchases in fiscal 2024. And they explicitly state they don't expect to use the rest of their existing $500 million buyback authorization.
Why not?
Because of the merger agreement. It includes customary restrictions that prevent things like large share buybacks while the deal is pending.
So the merger is really tying their hands on capital allocation too.
Completely. It just dominates everything right now.
Which brings us back to that crucial question. What if this merger doesn't happen? What are the potential consequences?
The company lays out several pretty serious potential adverse effects in the report. First, a negative market reaction. The stock price could take a hit. Management distraction is another big one. Fighting this takes enormous time and energy.
I can imagine.
Then there's the impact on relationships, customers, suppliers, employees. This uncertainty isn't good for anyone. And critically, they'd lose out on those anticipated benefits from NSC.
Like the investment committee.
Exactly. That promised $2.7 billion minimum investment from NSC, plus access to their technology. That would be gone. And, of course, shareholders wouldn't get that $55 per share cash premium, which is a major driver for the initial approval.
So the stakes are incredibly high if this deal falls through.
Very high, yes.
Great. So wrapping this up, assessing the business moving forward. What's the outlook for U.S. Steel? It seems like they're at a real crossroads.
I think that's a fair assessment. The path forward is multifaceted, as you said. It really depends on how well they execute their own strategy and how these major external pressures play out.
Their best for ally strategy is still the core plan, though.
It seems to be, yes.
Yeah.
They're clearly betting heavily on innovation, on EAF technology, on green steel solutions. That's how they plan to stay competitive, especially in higher margin markets, and how they hope to reach that ambitious net zero goal by 2050.
But they acknowledge challenges there, too.
They do. They mention that hitting those carbon targets might need breakthrough technologies, stuff that isn't maybe fully commercial or cost-effective yet. And it will definitely require significant capital investment over many years. It's a bold vision, but it's not without hurdles.
And then there's the merger outcome. That's the huge near-term question mark, right?
Absolutely critical. The legal battles around the Nippon Steel deal will shape their immediate future. It impacts market perception, operational focus, shareholder value, everything.
And even beyond the merger, the underlying industry challenges remain.
Right. Global overcapacity isn't going away. Raw material costs, energy costs, they fluctuate. And environmental regulations in the U.S. and Europe are only likely to get stricter. They have to navigate all of that constantly.
So it really is a story of transformation.
I think so. Transformation from a legacy integrated steel producer towards something more reliant on mini mills, on sustainable practices. But it's happening while they're wrestling with these huge economic, political, and regulatory forces.
A real test of resilience and adaptability.
Exactly.
Well, that brings us to the end of our deep dive into U.S. Steel's 2024 annual report. It's certainly a fascinating picture, a company with this deep industrial heritage, pushing hard into modernization and sustainability, but doing it under the shadow of this incredibly complex M&A situation.
It really highlights how dynamic even these established industries can be. The mix of strategy, market forces, politics. It creates a future that's anything but certain. It's a real case study in industrial change.
So what stands out most to you about U.S. Steel's current position? Do you think that Best for Alice strategy is strong enough to navigate these headwinds, especially if the merger fails? Can they truly become that next-gen steelmaker? Lots to think about there.
Definitely food for thought.
Keep exploring those questions. Thanks for joining us on The Deep Dive.